Sustainable ambitions. Across the globe, the top financial centres are pursuing sustainable finance in response to our low-carbon future, and accounting and finance professionals will play key roles. By Susan Muldowney. Article begins. The appetite for sustainable finance is growing. More corporations and governments are tapping into green capital markets to meet their environmental, social, and governance goals, collectively known as ESG, as well as mounting investor expectations. While the European market leads the way, Asia-Pacific is gaining ground, thanks to the green ambitions of centres like Singapore and Hong Kong, and the overwhelming acknowledgement of the need for a low-carbon future. Last year, global issuance of ESG-themed bonds exceeded $1 trillion, according to Climate Bonds Initiative, a UK-based not-for-profit that aims to mobilise the global bond market for climate change solutions. In Asia-Pacific, ESG-themed bonds made up 15% of bond offerings for the year. As the market continues to mature, accountants face fresh challenges in managing and integrating ESG data into overall financial performance. ESG-themed bonds are financial instruments linked to sustainability. Most are classified as use of proceeds and are issued to fund specific green, social, or sustainability projects. However, sustainability-linked bonds, SLBs, are also growing in popularity. Performance-based instruments, the interest margins of SLBs, vary according to the issuer's performance against predetermined, measurable ESG targets. The SLB segment saw rapid year-on-year growth in the first half of 2022, bringing total issuance to $46.6 billion, an increase of 5.2% compared with last year. In June last year, Australian conglomerate Wesfarmers issued the first SLB in the local market, raising $1 billion Australian dollars. The interest rates are linked to Wesfarmers' progress against two sustainability performance targets, and a step-up of 25 basis points will apply on the SLB's trigger dates if the targets are not met. The Australian green bond market is on track for a record-breaking year, with issuance already at 4.6 billion Australian dollars, compared with 2021's total of 6 billion, according to Bloomberg. Australia's ESG-themed bond market is expected to grow by about 25% to more than 25 billion this year. But mainland China remains the region's largest issuer. Last year, its green bond issuance grew by just over 230% year-on-year to $60.5 billion, according to Bloomberg. The market looks set to develop further, with the country pledging to reach carbon neutrality by 2060. In Singapore, green finance forms part of the Green Plan 2030 and will support the city-state's ambition to become the centre for environmentally sustainable finance in Asia. The government's 2021 budget included plans to issue green bonds for 19 billion Singapore dollars worth of infrastructure projects, including the Tuas Nexus integrated water and solid waste treatment facility. The government is also helping companies to access ESG financing through the Green and Sustainability-Linked Loan Grant Scheme for corporations and banks, which aims to reduce issuance costs. Hong Kong is also increasing its presence in the ESG sector. In 2020, green bond issuance reached $2.1 billion, according to data from the Climate Bonds Initiative. Hong Kong, and much of Asia for that matter, is riding on the global trend of sustainable finance and investment in terms of how society should allocate capital for a more sustainable future, says Felix Lam, Head of Investment Stewardship for Asia, excluding Japan, at JP Morgan Asset Management. Hong Kong is an important centre for finance and investing, adds Lam. It's also a major gateway to Asia and to China in particular, and this is one of the market forces behind Hong Kong's sustainable finance industry. Investor demand is a key driver of sustainable finance growth. A 2022 private equity barometer from Collar Capital shows that in the past 5 years, 64% of European private equity investors have increased the number of sectors they exclude from investment consideration for ESG reasons. Sectors on the exclusion list include weapons, thermal coal, and non-sustainable deforestation. Results also show that most investors across the globe think that ESG delivers positive impacts and filters out negatives. Climate change is a universal environmental concern for investors, with 93% reporting that they focus strongly on this risk when choosing investments. Terence Jeyaretnam, Oceania Climate Change and Sustainability Services Partner at EY, says, investors are pushing for greater transparency around ESG. Regulatory bodies are also wanting more information. For instance, in April this year, it became mandatory for Britain's largest businesses to disclose their climate-related risks and opportunities. The New Zealand government has also passed legislation making climate-related disclosures mandatory for some organisations. Climate risk is now globally recognised as financial risk, and it's driving investor decisions, says Nancy Wang, Director Sustainable Finance at ANZ in Hong Kong. Debt and equity investors realise that we need that level of disclosure transparency so that people can make the right decisions. Companies across the globe also want to demonstrate that an alignment between their sustainability strategy and capital structure. That's a very powerful story for them, adds Wang. While the sustainable finance market continues to grow across the region, there are obstacles for companies and investors to navigate. Sean Kidney, Climate Bonds Initiative CEO, says a key barrier is education about opportunity in the market. We've got the investors on side, but the markets aren't as rational as they make out they are, he says. Organisations are slow to get their act together and slow to notice a change, and that's the case everywhere. Kidney adds, we've shown now that with the green bond market, that green investments are lower risk and have lower volatility. That's why investors like it, and it keeps growing well. The corollary is, if you're not green, you'll clearly have more risk to volatility and the more risk of some sort of default or downgrade going forward. The lack of a universal green definition or taxonomy across global markets presents another barrier to growth. It can also amplify the risk of greenwashing of financial products. The Australian Securities and Investment Commission defines greenwashing in relation to investments as the practice of misrepresenting the extent to which a financial product or investment strategy is environmentally friendly, sustainable, or ethical. EY's Jeyaretnam says the assurance process can enhance investor protection from greenwashing. When you think about where ESG information has been focused over the past 2 decades, it was generally about telling a good story about corporate social responsibility. Today, it's about core risks and opportunities to business. So you have to put some controls in place to manage inherent biases. I don't see sustainability assurance as that different to financial assurance, adds Jeyaretnam. In financial assurance, you're required to look at how the information is presented outside of financial statements to ensure that the narrative is consistent with the performance of the organisation financially. We'd have similar conversations about organisations regarding sustainability performance, he adds. The recently formed International Sustainability Standards Board, the ISSB, also aims to deliver a comprehensive global baseline of sustainability-related disclosure standards to help investors and other capital markets participants to make more informed decisions. Jeyaretnam says, with ISSB accounting standards, you'd not only have to integrate ESG reporting with financial reporting information, But you'd also have to talk about ESG data governance, and that has to be at the same level as financial data governance. I think a new challenge for organisations will be how they manage this outside of things like Excel spreadsheets. Integration across ESG and financial disclosures is one factor currently reshaping corporate reporting. JP Morgan's Felix Lam says it may present a greater challenge for smaller companies with fewer resources, and he recommends focusing on the materiality of ESG. He says, ESG encompasses many areas, such as human rights, climate change, and social impact. But when we are assessing materiality, we look at how these factors impact the financial performance. ISSB will hopefully help to bring about a more united framework and ideally a reporting standard to certain material issues, particularly around climate change. I think this will help accountants to understand how they can integrate both financial materiality and ESG materiality. Since 2020, several regulations on disclosure of ESG information have been announced by financial regulatory bodies in mainland China. Dr. Rao Wang, director at China's Xiamen National Accounting Institute, says the regulations are a positive signal of mandatory ESG disclosure and that relevant accounting skills may require further development. As a comparatively new concept, ESG needs both applied research at the technical level and theoretical construction to ensure its sustainable development in China, says Wang, a contributor to the ESG Reporting White Paper 2021, created by CPA Australia and the Xiamen National Accounting Institute. As the sustainable finance market continues to grow across Asia Pacific, so too will the requirements for ESG disclosure. I think there'll be a test for the accounting profession around how ESG data is measured, managed, and reported, and how it's integrated into financial performance, says Jaya Retnam. If you look at the climate risk space, we're starting to have guidance around how it may impact contingent values, stranded assets, and write-offs. So there's a bit of learning to do in terms of how that intersects with financial reporting. I think accountants can bring a lot to the ESG field in terms of better data governance and better hygiene in data management, adds Terence Jararatnam. So I actually think it goes both ways. Accountants will have a lot to learn, but also a lot to bring. Sustainable finance plays a vital role in supporting and accelerating the move to a low-carbon economy. Its transition finance segment can help businesses in hard-to-abate sectors, such as aviation and petrochemical, to reduce their emissions. Transition bonds tripled in volume in the second quarter of 2022, with 23 transition bonds from 17 issuers totaling $2.1 billion. Most of the 2022 bonds originated from mainland China and Japan's transition finance programs. Among them, in Japan, Idemitsu issued 20 billion yen in transition bonds in July to convert its oil refining facilities into renewable energy hubs. JFE Holdings raised 30 billion yen in June to make its steelmaking process more efficient. Emily Tonkin, Executive Director, Sustainable Finance at ANZ in Sydney, expects the transition label to mature in the loan market before growing in the bond market. She says, the transition-labelled bond market is still very much in its infancy, with issuers typically using green or sustainability-linked instead. We may need to see a few more large global transactions go through with a transition label before it really takes off. When we talk to customers in high-emitting sectors, they're very keen to hear about what's happening with this product. I think we need to just get a bit more momentum in the transition label, as we think there's still a great opportunity for this type of product. Dr. Wang says transition finance has the potential to facilitate real change in the global economy, but that it requires mandatory standards that underpin tangible contributions towards a future energy system. As capital providers examine their options for accelerating progress on climate change mitigation, transparent criteria in managing continued funding in hard to abate sectors will play a crucial role.